Hey guys, so in today's video, I'm going to be going over 5 stocks to buy in September of 2017. And I know I made my stocks to buy in August video just a few weeks ago, so some of these picks are going to be the same as last month, but I did manage to include 2 different picks, and then 3 of them are the same as last month. And if you're new to this channel, I make videos on the stock market and investing, so if you're interested in that, consider subscribing, and let's get right into the video. So, similar to the last 2 months, this will be a more brief overview of the 5 companies that I am buying in September, and then will have in-depth analysis videos on all 5 of those, and I will link those in the description as well as put cards in the top right. So, the first company that I think is a good stock to buy in September of 2017 is Nike. The symbol for Nike is NKE. And I like Nike because they're a very strong brand. When I think of footwear, I think of Nike right away. I also like them because they are trading at a discount to their historical price to earnings. And so this could mean that they are cheaper than usual, which could offer a good buying opportunity. I also like them because they have strong growth and they are continuing to grow. So they have a price to earnings of 21, which is a bit of a premium to what I like to see, but they're a very well-run company with low debt that generates lots of cash flow, and I think they have very strong future growth prospects, which means that I think this increased price to earnings is definitely justified. I also think that they are a great stock because China is currently pushing athletics as a way to grow their GDP, and China has quite a few people, so if Nike can grow strong in China, then that will offer great growth for them, and I think that that will definitely help to boost their revenue and their earnings. They are down over the last couple days because Foot Locker posted terrible earnings. Foot Locker is down like 30%, and this dragged Nike down. I recommended Nike a few months ago, and then they jumped 10% on a great earnings report, but almost all of those gains have been erased just because Foot Locker posted bad earnings. And I can see where people are concerned because Foot Locker does sell Nike products. However, I don't see the struggles of Foot Locker as struggles that will affect Nike long term because Nike makes the product. It doesn't matter whether people buy that product from Foot Locker, from Nike directly, or on Amazon. Nike is still going to get that sale. So this could hurt Nike in the short term, but people are still going to need shoes, and if they're a fan of Nike, they're still going to buy Nike shoes even if Foot Locker isn't around. And if Nike sells more shoes direct because Foot Locker isn't selling as many shoes, then that would actually benefit Nike because they'll cut out Foot Locker making a profit and they'll be able to make more profit themselves. So I really don't see this as being a problem for Nike at all. So the second stock that I think is a good stock to buy in September of 2017 is Delta Airlines. The symbol for Delta is DAL, and I'm a fan of Delta Airlines first off because they have a very strong brand. When I think of flying, the first thing that comes to my mind is Delta. I always fly Delta personally. I also think Delta is the best airline. They are the best in terms of cash flow generation compared to all the other airlines. They have a very strong balance sheet, especially compared to the other airlines, which is very important because airlines are a very cyclical industry. And so if they don't have a strong balance sheet during the next downturn, they could be very negatively affected. However, Delta has a strong balance sheet. Delta also is the best airline for customer treatment. They are late less than any other airline. They lose your bags less than any other airline. So all in all, I think they're the best airline. However, they are trading at a pretty strong discount to the airline industry. They currently have a price to earnings of 9.15 compared to an industry average of, I think, 14. So I think Delta should definitely be trading at or above the average price to earnings of the airline industry. However, they are trading at a very significant discount, which offers a great buying opportunity. Delta also pulled back recently. They were on a very nice upward trend, and they've been up, I think, over 50% in the last year or two. But they pulled back about 15% recently, and I think this offers a very attractive entry point. Delta also recently raised their dividend by 50% to 2.5%. This is very great because it means that Delta is super confident in the future. A company doesn't raise their dividend by 50% and then go and cut it very soon because shareholders see a dividend increase as a commitment, and if a company cuts their dividend, many people will sell the stock off. So this is another sign of strong stability with Delta. Delta is also benefited by having low oil prices. One of the main expenses for airlines is oil because they need fuel, and so low oil prices are very helpful to Delta. Delta even has their own refinery, which they use to slightly reduce their gas price. The third stock that I think is a good buy in September of 2017 is Exxon Mobil. The symbol for them is XOM, and I like Exxon Mobil because they're a very strong integrated oil company. This means that they have their upstream production where they're pulling the oil out of the ground, but they also have refining and they have chemicals. This means that even in a low oil price environment, Exxon Mobil can generate strong free cash flow because their downstream and their chemical segments don't rely on the price of oil, just their upstream does. So this allows them to be stable, and this is what has allowed Exxon Mobil to raise their dividend every single year for the past 35 years. Exxon Mobil also has some strong growth prospects. They are going to roll out gas stations in Mexico, as well as they have a Liza development oil field, which is likely going to produce them about 130,000 barrels of oil per day and will generate double-digit discounted cash flow returns even at $40 per barrel for oil. So this is strong growth prospect for them. ExxonMobil currently has a 4% dividend, and they are definitely not going to cut this dividend anytime soon. And I think this dividend is very safe. ExxonMobil has very low debt. ExxonMobil has lower debt than Chevron, even though ExxonMobil is almost twice as big of a company as Chevron. So I think ExxonMobil is a very strong company that is one of the safest oil companies out there. If you see oil jumping to $70 a barrel anytime soon, then ExxonMobil might not be your best bet because an independent oil producer will have more upside if there's a strong increase in oil prices. So if you think oil prices are going to spike up soon, then maybe ConocoPhillips would be a good buy. But if you think that oil is going to remain around $45 to $55 per barrel and then slowly go back up, ExxonMobil is definitely the oil company for you because they are very safe and they will continue to pay their dividend even at lower oil prices, so you can reinvest those dividends while you wait for oil prices to go back up. The fourth stock that I think is a good stock to buy in September of 2017 is Shire PLC. The symbol for them is SHPG. They are a pharmaceutical company that is based in Ireland but also has a headquarters in the United States, and they have an ADR that trades on the New York Stock Exchange. So I like Shire for quite a few reasons. The first being that they have an 8.8 forward price to earnings. This is super cheap. I really cannot figure out why Shire is such a cheap company. I bought them a few months ago and I'm actually down quite a bit, but I still think that they are a very strong company to buy. They showed very strong growth in this most recent quarter, and they paid down $880 million in debt in the most recent quarter off of their $1.2 billion in free cash flow. They are down recently for several reasons. The first being their CFO resigned. It's not an instantaneous resign. He is going to leave the company at the end of the year. And I don't see this as being a huge deal. They can always get a new CFO. So going down 4% on that seems like a bit of an overreaction. And then they were also down quite a bit on their earnings report. Even though they beat top line and bottom line earnings, they went down for the several days after earnings by quite a bit. So this was surprising to me. I have no clue why they went down. So this is one of those stocks where I don't really know why it's so cheap, but it seems like a great buying opportunity. And in the most recent quarter, they realized $400 million in cost synergies from their acquisition of Bexalta, which is great to see that their acquisition is already starting to pay off quite a bit. This allowed them to raise their EPS guidance. They did lower revenue guidance due to increased competition. However, they raised EPS guidance, so I don't see this as being a positive or a negative. I think the increase in EPS guidance and decrease in revenue guidance just sort of cancel each other out. And so, like I said, I don't really get why it's so cheap. They have a strong pipeline. They have strong growth. The only thing that I can really think of is generic ADHD as being a problem for them. A lot of generic drugs are coming out to compete with their ADHD drugs, but ADHD isn't even a huge part of their business. And generic ADHD drugs I don't think work as well as the ones made by Shire, so I don't see that as being a massive problem for them. Like I said, I don't get why this is so cheap. I think it is a great buying opportunity in September of 2017. And the fifth and final stock that I think is a good buy in September of 2017 is Molson Coors Brewing Company. The symbol for them is TAP. And I like Molson Coors because they have quite a few strong brands. They have Coors Light, Miller Lite, Blue Moon, and many others. They are also a consumer staples company, and 9 years into an expansionary period, it's not the worst idea to shift some of your portfolio into safer consumer staples companies. They have a 15.7 forward price to earnings, which is quite a bit cheaper than the consumer staples sector average, so that is good to see. They also have a very low payout ratio at under 20%. They said that they are not going to raise their dividend until they pay down their debt. And last quarter they managed to pay down $522 million in debt. So this is quite significant. It means that they are having no problem paying off the debt that they took on to finish their acquisition of Miller Coors. And that they will be able to continue raising their dividend again soon, which is great to see. I like that management did prioritize paying down debt to raising their dividend. This is better for the financial health of the company. And they also have very strong margins. I think Molson Coors has around a 30% net margin, which is a lot better than their industry average. So I think they are overall a well-managed company. They are safe because they are consumer staples. They are working on paying down their debt, which they have been very successful with so far, which should mean that they are able to raise their dividend again soon, which is very important to me. So thank you for watching. These are the 5 stocks that I think are good buys in September of 2017. What stocks are you guys buying this month? Leave a comment down below. And like I said at the beginning of the video, all of the links to the more in-depth analysis videos on these stocks will be in the description. So if you're interested in watching a more in-depth analysis of any of these companies, check those links out. Thank you for watching. Please remember to like and subscribe.